Good morning, ladies and gentlemen. Thanks for joining us for ITW's 15th anniversary. I hope you've had a busy and fruitful morning and a couple of days previously and have plenty of meetings booked for the next few. We've had the time reconnecting the industry. It's been great to see all your faces, 5,200 on site, so it's a great number back after the pandemic. So next up, we've got a panel discussion about sustaining investment demand for digital infrastructure in a post-COVID world, which is part of our investment and governance track. Before I begin, though, I'd like to thank all of our sponsors, specifically our diamonds, AT&T, Deutsche Telekom, STC, and Telefonica, for making this all possible. Joining us now is Kamal Haber, partner and shareholder at Greenberg Traurig. So, without further ado, over to you, Kamal.
All right, welcome. So quick introductions, and then they'll go into a little bit more introduction of themselves. We have a distinguished panel today. I'll start. I'm the moderator, Kamal Haber, Greenberg Traurig. Very quickly, we're one of the largest firms in the world, largest digital infrastructure practice in the world, and I am the global head of the practice. We have Warren Roll, Managing Director of DigitalBridge, Josh Pang, Managing Director and Head of Digital Infrastructure at Carlyle Global Infrastructure, and Corey Welp, Co-founder and Managing Partner at 1547. Stephen, who is here at the conference, unfortunately, we had a casualty, so we wish him speedy recovery, but he is now quarantined in his hotel room, so we left his chair here in his honor. Why don't we turn it over to you, Stephen, Warren, to give a little more background on yourself.
Sure. Good morning, everybody. Nice to see a crowd here this morning. My name's Warren Roll. I'm a managing director partner at DigitalBridge. DigitalBridge is a global private equity fund that's focused primarily on digital infrastructure. I lead the fiber and small cells practice, and I'm happy to be here with my peers.
Thanks. Hey, everyone. Great to be in person again at ITW. I'm Josh Pang. I'm a managing director at Carlyle, and I lead our digital infrastructure vertical within the infrastructure private equity group. I think folks know Carlyle's a large global private equity and alternative asset manager. We have over $325 billion under management, and our global private equity division is one of the largest in the world. We take a diversified approach to investing. For me, within the infrastructure PE group, I spend my time across asset classes. That includes data centers, fiber, towers, mobile, subsea, et cetera, et cetera. We'll talk about this a little bit later, but we do have expertise across a number of areas, including renewables, TMT, et cetera. And as those sectors converge, we bring the resources within our firm to look at a given deal and create our value-add proposition. Thank you.
Hello, everyone. Corey Welp. I'm the co-founder of 1547. We are a data center-focused company. We acquire and operate and manage data centers throughout North America and Europe. So we're focused on Western Europe and North America currently. We look for opportunities that are often retrofit, highly connected assets. We own the Pittock block out in Portland, an asset in Hawaii. We're very focused on edge assets and have high conviction over the edge story in our investment thesis. It's nice to be here today, and it is great to see everyone in person again instead of the Zoom conferences that were not quite as fun.
Well, great. Well, the first question we're going to keep with the overall caption here, digital infrastructure in a post-COVID world, and I'm going to combine a couple of the questions here and give a little bit of a preface. It's with COVID, I think it's fair to say that digital infrastructure has proven itself to be not only central to the economy, but to society as a whole. And in fact, it's digital infrastructure that enabled people to work from home and school from home and entertain and stream Netflix from home. Has the pandemic caused a shift in demand for digital infrastructure, or is this demand that was already existing and it was just maybe accelerated because of the demand? Why don't we start with Warren on this one, and then we'll go to Josh.
Well, I think if you sort of think back over the last 700, 800, 900 days, you go back in time and ask yourself the question of, was I ready? Did I think I was ready to do everything that I was doing virtually? And I think if I had to, at the highest level, define it, I would say that we all realized how easy it is, that the technology is there, that the bandwidth exists to live and be extremely successful professionally and personally with the technology that exists. And so I think from that perspective, you can actually see a lot of extremely high productivity over the last couple of years by working virtually. And so I think it was going in that direction anyways. There's a lot of very interesting statistics out there. One that I continuously use is that 20% of global workflows are currently in the cloud. And I don't think that number was slowing down anytime soon. It might, cloud compute continues to be one of the largest drivers of global connectivity, data center demand, and bandwidth. And so from my perspective, I don't think the pandemic actually sped anything up. I think it just made everybody realize how easy it is to work remotely, be flexible, and obviously workflows are shifting as we speak, continuously shifting, and bandwidth requirements continue to increase. And so my perspective is that it was going that direction anyways. It will continue to go in that direction, and it's not going to slow down anytime soon.
Josh?
Yeah, I fully agree with what Warren said. To give you a tangible example, it's a little bit of from column A and column B. Things have changed, and continuation emphasis on the products and services that we already knew existed. In column A, private equity is largely in-person business. We go to investment committees, we have meetings, in-person meetings like this. A lot of it shifted over to Zoom, so that's a real change in the way that we operate. From column B, some of the collaboration tools that leverage digital infrastructure, cloud-based applications, file sharing, collaboration, platforms, we had already been using. So we liked it already, but the value of those platforms were emphasized and highlighted as the pandemic changed the way we worked. So, agree with that.
Corey?
Yeah, so from a data center focus, again, these guys have a lot broader focus than I do, but what I believe we saw was it was an acceleration of the cloud and cloud applications. We saw it through leasing. So the leasing statistics for the cloud companies were before the pandemic hitting records and then breaking those records throughout COVID. But at the same time, the enterprise leasing did not keep pace. So there was a question: is their enterprise completely going away from their own data centers? Are they now just focused on the cloud? But it had a lot more to do with the in-person activity and opportunities, because what we've seen post-pandemic is a significant spike in enterprise leasing. And so that's been, I think, an interesting piece. From anecdotally, I think that there's 0% chance that my 80-year-old mother would have ever figured out how to use Zoom unless that was the only way she could communicate with her grandchildren in person. And so accelerating the usage and highlighting for people that had issues with their broadband or their bandwidth, personally, whether it's professionally or personally, I think that it highlighted any cracks in the infrastructure and where there needed to be improvements. So it accelerated then some spend to plug some of those cracks.
Well, what's interesting also is that I think different constituents now look at connectivity as much more of a priority than pre-pandemic, right? You can see it obviously with just overall government funding globally. Government subsidization has rapidly increased in order to connect different countries, different cities. as fast as possible. We see it obviously in the United States in a profound way with the recent infrastructure bill that was passed, and a big chunk of that, so over $60 billion, that's going to be directed primarily to fiber and connectivity, and a lot of that's going to go to residential. So I think from the perspective of global broadband becoming more of a utility than ever before is something that's changed.
Great. Now, jumping to questions that's just fascinating to me, having grown up in the industry over the last 3 decades. 20 years ago, these are my timelines, of course, no aspect of digital infrastructure was categorized as infrastructure, as an asset class. It was only around a decade ago that I think towers and maybe data centers first started to get financed as infrastructure. And now we're talking about, even on this panel, we're talking about digital infrastructure in almost utility-esque terms, and utility is classic infrastructure. Josh, what is infrastructure, and how has this evolved, and how does it affect financing? Small question.
This is one of my favorite questions, Kamal, because if you ask 10 people this question, you're going to get 15 different answers. So, at least for us at Carlyle, when we think about the infrastructure asset classes, there are 2 things that we primarily look at. The first is, what is actually delivering the value of the service? Is it hard assets in the ground? Is it infrastructure assets that is enabling the value proposition? So that's one. And the second is, how mission critical is that service? Are there substitutes? What are the alternatives for the customers? And when you put those things together, for example, I think a great example is fiber to the home. Some people think it's infrastructure. Other people don't think it's infrastructure. For us, we do think it's infrastructure. It's got elements of infrastructure as well as private equity. The value proposition comes from the fiber in the ground. It's internet service that folks need to use for their everyday lives. And if you look at it from a contract standpoint, Warren, Corey, and I were debating this earlier today, yesterday. Do you need 10-year, 15-year contracts to classify something as infrastructure? That's great to have. You would love to lock in a household to 10, 15-year contracts, but no one's going to be able to do that, right? So you look at the actual adjusted churn of that household. How often do the actual households churn? And when that family or person moves out, is there a new family that comes in and takes internet from the household on the fiber that's dropped to that household? So when you look at effective churn, in a lot of ways, this is more stable and has lower churn than some of the other asset classes. So that's how we think about it. It's a creative way to think about it, and I think it will continue to evolve over time.
Warren?
So, I have the luxury of actually sitting over the last 10 years in this industry and actually watching all of the different subsectors. So, fiber, small cells, data centers, and towers. Towers obviously being probably the most infrastructure-like, or even hyperscale data centers also being pretty infrastructure-like, or even we talked about potentially real estate. But certainly over the last 10 years, you've seen such an evolution. I got into this crazy business, investing in satellites on the private equity side about 12, 14 years ago. And that obviously in itself could be considered an essential service, providing a lot of the services that they claim they're going to be able to provide, and but also has an incredible amount of capex associated with it. But that, when you sort of look at that business and the geo business, which was underlined by 15-year contracts, you could argue for being absolutely infrastructure, like providing wholesale services. So when you think about over the last 10 years, what's happened is it's hard to make really great returns in the infrastructure side, right? Infrastructure investments were yielding 5%, 6%, 7%, and while that was going on, a lot of lower cost of capital was entering into digital infrastructure, which kind of had a lot of hybrid attributes to it. It had a little bit of infrastructure, had a little bit of private equity, had a little bit of real estate to it, but overall, it had incredible tailwinds with either contracted revenues or uncontracted revenues in areas where once you have a direct path into a home, whether it's plumbing or it's broadband, and you have very little competition, you're going to have a pretty long duration customer over time. And so I think that's what's happened is it's taken a little bit of time, but the investment community has seen that digital infrastructure, as we talked about in the first question, or our discussion on just overall pandemic, and what's happened is everybody's eyes have opened up and realized that this is an absolute essential service, and whether there's a long duration contract associated with not, it's not going to churn as fast as people think. So you look at each of the different subsectors, I think. You look at towers, very, very infrastructure-like attributes to it, obviously. Zoning restrictions, permitting restrictions. You look at data centers, generally, when you create a very tight ecosystem, and not all assets are created equally, obviously, but when you sort of just at a high level look at either co-location ecosystem or a data center that's built for Microsoft, Google, and Facebook, a lot of these assets really have a lot of infrastructure attributes, and that's one of the reasons why there's been so much heavy investment from infrastructure funds over the last decade.
Corey, did you have anything to add on this one?
Yeah, I think that their broad exposure to the, across the asset class is probably better way to look at it. What I'll say is that it has changed the face of the capital the investments based on the capital that you have. So the cost of capital has come down significantly if you're dealing with infrastructure capital. If you're dealing with real estate capital, they're expecting a higher rate of return. And the cost of capital there is higher. So it's had impact throughout, and we have a lot of, we talked about the conversations with our LPs. They like to argue, the investors in our funds like to argue sometimes about whether or not the real estate guys get it or the infrastructure guys are the ones that are able to invest in the space. So it's not clear, but I think these guys summed it up well. I like the plumbing example. My kids would rather do it without plumbing than without their internet service, Warren.
What's interesting is we had that conversation a decade ago, and it was such a different conversation. It was an argument. Like it wasn't that long ago when we were arguing about whether or not people were going to pay $100 for higher speed broadband. It wasn't a discussion of gigabit. It was how fast the cable guys could reach you and what they could provide. And it was a very different discussion. I think folks didn't really think about where we are today and how many applications you're running, and obviously working from home and the need for speed. So different conversation in 2022, and I think that everybody sort of sees that it is an essential service, and you see that governed by the governments.
Great. This is actually probably a good point. I meant to say this at the beginning, that we accept questions throughout, so it's actually preferable to wait until the end. So if anybody has any question at any point on any of these points, just raise your hand, and I will see you despite the glaring light in my eyes here. Okay. So unless there are any questions, I'm going to jump to the next question here. So it builds on something Josh mentioned and segues nicely from the previous question. For a lot of my larger financial sponsor clients, who have multiple pockets of investments, they have a private equity practice, they have an infrastructure fund, they have a real estate fund, they have special situations. But in any event, you're looking. You look at the same asset, say a data center or a tower, and then the real estate folks will say, it kind of looks like real estate. This is a structure on a piece of land, but it's operationally intense, so I'm not sure it fits. And then the PE guys look at it from a cash flow perspective, and then you have the infrastructure funds that say, hey, this looks a lot like infrastructure, but it's not a toll bridge where we cut the ribbon and just accept concessions one way. So Warren, why don't you start with this one, then we're going to go to Josh on on your take on these various pockets of investment.
I'm not a title guy. I think we have the luxury of focusing on one thing and one thing only. We have a very long-term view on digital infrastructure, and that's our vision, is that there's going to be a tremendous amount of tailwinds for the very foreseeable future and beyond. I don't think anybody else in this room would disagree with that, and I think that we made the decision a decade ago, if not before that, when we were investing just in towers, that this was the place to invest for us. So does it matter whether it's real estate? Does it matter if it's infrastructure? Does it matter if it's private equity? I think what we're always looking for is the right return, the right returns adjusted for risk for our funds. But our funds only invest in one thing, and one thing only. And so we'll find a home for it because we're long-term believers in the entire sector.
Bit of a cop-out answer, but
No, that makes a lot of sense. I mean, to your point, Kamal, with large PE shops, with hundreds of billions under management, when a given deal comes in, a given data center deal, fiber deal, tower deal, et cetera, there's usually more than one fund or group that deal could go into. And the way that we approach it at Carlyle is that we're one team, one dream. And we've got that tattooed on our arms, by the way. It's part of the orientation process. And what we do is we bring in the experts across, our firm to look at a given deal. For example, if we're looking at a deal in Asia, we could bring in the Asia buyout team to look at a given geography, geopolitical risk, et cetera. If a data center deal has a significant real estate component, such as in hyperscale, our real estate team comes in and helps us evaluate, the aspects of the real estate that are salient for the deal. And then what we do, ultimately, is we try to share deals across funds. It's not a binary thing where one fund might get 100% of the equity deal. We might actually split it. We might actually split it 2 or 3 ways. And we actually did that in infrastructure. There was a deal not too long ago that was split between our Asia buyout team and infrastructure because it had characteristics that both of us liked. And when you share the wealth around the table, it makes everyone happier. Collaboration is easier. We work together on diligence and value add, and hopefully that means better decisions and ultimately better results.
And then you'll invest across the funds in the opportunities?
Yeah, that's right.
All right, that's interesting. We see that typically it's a binary one or the other from investors. It's a core investment, that is stabilized coupon clipping real estate almost looking type of a investment, or it's an opportunity investment. From our perspective, we're looking for more the opportunistic, the opportunistic smaller opportunities where we can drive value with our team. That's really primarily what we're looking for. So, does that cross into the infrastructure space? Is that we believe it does. We believe the core nodes of connectivity are highly critical to the infrastructure for everything that's done in the internet. So, that's fundamentally what we believe, and our investors agree.
So Corey, coming to you with the next question to start. We're seeing a lot of the advent of new technologies, whether it be 5G, IoT, big data, and it's putting a lot of pressure on the network, especially around the edge, and you're seeing a bit of a renewed focus on moving away from the first-tier markets. Do you expect that second and third-tier markets are going to be getting a lot more investment in the next 5 years, or it's going to be a lot more data centers, a lot more fiber, or are we going to keep investing in the same big markets?
Well, I think that we're making, as a company, we're making absolutely a bet on just that. It's hard to go find comps for data centers in a market like Milwaukee, but we believe the 2 million people there are going to demand. They're going to demand a connectivity experience that is going to require caching of content to be closer to their eyeballs. So we fully believe that yes is the answer. It's interesting when you look back, and we were talking with some of the networks folks about in Amsterdam about how you used to have to basically pop back from Europe to the U.S. to go back to Europe, so any communication, and then the evolution of that is if you're in Houston and you're communicating with San Antonio, you have to go to Dallas, and these ecosystems are evolving and changing. The next evolution in our mind is those second and third tier markets, and that doesn't mean there aren't going to be the continued expansion of markets like Ashburn, But in terms of getting in front of the curve, we certainly believe that that's going to happen, and we're making investments that are focused there in edge markets.
Warren, are we going to see fiber to the home in a meaningful way?
First on that, also, yep. I think that we agree. So we're also making significant investments in edge compute. We have one of the largest edge data centers in the United States, which is DataBank, with almost 100 locations. And we just invested with Liberty in Atlas Edge in Europe's same idea, trying to provide edge locations to our customers. And we're hearing it from our customers. We're hearing workflows shift. We're hearing hyperscale customers. We're hearing enterprise customers that are shifting workflows and want space closer to the edge, whatever the edge means. The edge can mean your house. The edge can mean your office building. The edge can mean periphery of cities that there wasn't compute in. And the reason is to lower that latency in the experience. So we do believe that there's going to be continued investment in digital infrastructure, both in the data centers, both with connectivity and fiber. And on your question with regards to fiber to the home, we've just made a couple of investments in fiber to the home, and I think we're literally in the first inning. There's going to be a tremendous amount of fiber construction, not just in the United States, but globally. We just invested in a fiber construction business in the UK called Netomnia, and another one in LATAM. And we don't see it stopping for the next decade. There's a tremendous amount of construction to be completed. Not all of it right now is totally economic, but there's enough to go around, and I think that it's a great opportunity, especially when you're going to probably talk about valuations, because I know this panel, but in a time when valuations are, as we all know, I don't know what's happening in the markets today, but decently high enough still, constructing and building networks is a lot more economic.
I think I'm going to fold this audience question into the valuation question. So let's start with the valuation question. Unless, Josh, did you have anything to add on the second or third tier markets?
No,
let's jump to Josh with you on valuations. For better or worse, and that depends on your perspective, valuation multiples are high throughout the sector. First, why is that the case? Why are we seeing multiples in digital infrastructure sector that so far exceed the multiples you see in other asset classes? And then, why don't we just start there, and then we'll build from there.
Sure. So, I think everyone knows valuations are high because a number of reasons. It's the confidence that investors have gotten over the past 10, 5, last 2 years over all the secular themes that we talked about, that Warren and Corey and Kamal you talked about. So these are long-term secular themes of using technology to enable daily activities in business, and the underlying infrastructure that we're talking about here is core to that. That's one of the reasons why valuations are high. If you're talking about where valuations are going, is that your next question, or?
Yeah,
sure.
Go ahead.
So, I think it's in vogue right now to talk about downward pressure on valuation. Everyone knows that cost of capital is going up with the Fed rate hikes. There's fears of inflation and potential slowing of growth. But if I were to drink the Kool-Aid, that I have here, that we're all drinking, is that, digital infrastructure is one of the safest sectors to invest in the long term. What sectors, well, not many sectors, have grown through the past 2 recessions, through the COVID pandemic, through the GFC, so towers, data centers, fiber. It's one of those great sectors that you see that resilience. And that flight to safety can arguably offset some of the downward pressure in valuations that we're seeing now. But that's my Kool-Aid talking. So.
I would just say, and Josh, you're 100% right. So if you go back in time and you look at recessionary periods, you look at 2008, everything went down, right? You're not going to escape that. So, but I do think that when you look at the trends in this industry overall, You have tremendous amount of growth that could slow, but overall the long-term thesis is sound, and I think that's critical. I think the cost of capital will go up. I think valuations will shrink, but what you will see is pops in our sector faster than others. You can sort of just go back and look at the tower industry in 2008, and they came back faster than everybody else. And I think that will hold true today. I think that, listen, NASDAQ's down, 40%? I still think that, underlying cloud compute has a tremendous amount of growth ahead of it. And so I obviously have drank the Kool-Aid, but I do think, when I made the bet 14 years ago to focus all of my attention and my career on digital infrastructure was because I could see 20 years out in a sector that had, whether there was contractual revenue or not, a tremendous amount of growth with generally safe customers.
Corey, do you want to add anything to this one?
Well, I'd just say that we do have a long history in this industry of, sometimes the second guy to own assets makes all the money. So there are periods where mistakes happen, and what we're seeing with the multiples are that the multiples you're getting incredible multiples for quality. So leaders in markets or high quality businesses are getting very high quality multiples, and we're starting to see some erosion of some of those multiples on the lesser quality businesses, which I think is important because you can't ignore the macro themes. Inflation is if that is a variable that goes up in your financial model, it has an impact that is real. The cap rates and multiples are based upon interest rates. So where are interest rates going to be? What's your prediction and your protection on that? So you have to take these things into consideration, and we all do in investments. But you've seen some of the the acquisitions that these guys have made at high multiples. We bought in Portland, the Pittock block. We believe that the multiple is justified for that asset. But the quality of companies that are being acquired are to me, that's the differentiator.
The spirit here of the second audience question is actually a question that I have, if I understand the spirit correctly, is a question that I always have myself, and maybe we'll start with Warren on this one again. And that is, whenever it comes to valuation, it's EBITDA times a multiple, is that just the way it is, or more to Corey's point, is there a more qualitative analysis that differentiates among businesses, or is it more, as the question said, it's a spreadsheet-based decision calculation?
I don't know if I can answer this question in a minute or two. I mean, the answer is everything is circumstantial. The answers are not sitting in a spreadsheet. The answer, from my perspective, actually, with people, management teams, and the folks that are there to drive alpha out of our businesses. Of course, you can do a certain amount of research and analysis on a spreadsheet that gets a conversation going, but I think overall, you've got to look at the bigger picture and understand where the investment or where the assets are, who they compete against. There's a plethora of things that we look at. So it's not just in the spreadsheet. We bet on management teams. We bet on people. And overall, like we said, our thesis is long-term in this sector. And we don't deviate from that. There's going to be a tremendous amount of opportunity globally for this asset class, if you will. And I think if you just made your bets on spreadsheets, you probably have a rude awakening. It's a very complicated asset class that requires a lot of specialty.
Josh?
I fully agree with what Warren said. As David Rubenstein once said, private equity is man's highest calling. So, there's a lot of elements that go into investment analysis. And the Excel spreadsheet, which, by the way, I'm not sure if any of us on stage have recently dug into any Excel spreadsheets, but long story short, the financial analysis is absolutely important. It's one of the key ingredients that goes into our analysis of a given investment opportunity. But like Warren said, we're betting on people, themes, and a lot of the qualitative stuff that you don't see in an Excel spreadsheet and data. And you have to make a judgment call, and that's what investing is.
Yeah, I have analysts that would be crushed if I said that Excel wasn't important. So as much time as you spend working through it, and ultimately it is math and how, on the exit, the companies are going to look at it, but fundamentally, is it the right asset, the right opportunity to grow the opportunities? In our case, do we have a team that we believe we can do better with an asset that the previous ownership has? And that's the alpha that we're counting on there. But it drives a growth case, which is an input into a spreadsheet that ultimately, it requires an output that works as an investment. So, to answer, I guess, that question, to me, it's not going away, because the math is sort of the critical piece.
As we're running low on time, I'm going to try to combine these audience questions with a couple of our own. But let's start with the question, and I won't specify Netflix here, the Netflix question, because I was watching MSNBC on Tuesday and Tuesday morning, and the great tech companies, I saw the headline was they lost $1 trillion in value between Monday and Tuesday. Of course, when you take the top 10 tech companies, 100 billion, 200 billion of value is not that. But does something like that, do you ever lose confidence in the sector, or is confidence shaken, or make you step back? Let's start with Josh on this one.
The beauty of our business is that we care less about quarter-to-quarter earnings. What happens in any 3-month period, we should pay attention to for sure, and read and take into account what folks are saying. But the underlying theme is, we think streaming, digital media, on-demand content, and sharing of that content is probably going to be something that you can count on continuing into the foreseeable future. So while Netflix, I believe had a pretty terrible quarter, we think that the underlying infrastructure that enables Netflix, and by the way, its competitors as well, and substitutes, will be there. Because we're not betting on Netflix. We're betting that there will be consumption of Netflix-like services and other types of things that enable, kind of our everyday lives.
I think that's exactly the answer, right? Like, is the bet that we're all going back to $39.99 a month to get video on satellite? And I mean, if you speak to my kids, the answer is unequivocally no, right? There's 30 different wireless widgets in my house that you can look at. There's probably 100 that are attached to Wi-Fi. And everybody's watching YouTube. And whether Netflix exists in a year or 10 or 20 from now, it's irrelevant. I think that the way we consume data has changed already, and that's not changing. That paradigm shift happened. And so the infrastructure needs to get built in order to continue to absorb that data, right? That data might become 3D or 4D one day, which it is actually already. And so Netflix to us also doesn't affect us in the least, but doesn't bother me in the least, because I know what's going on with Netflix and Netflix-like customers, and they are absolutely interested in figuring out how to provide better, more richer content to the users. The users are my kids, and apparently they will pay, whether I like it or not. Yeah.
Let me jump quickly, stick with you, Warren, on the fiber to the home. I'm seeing more fiber to the home business models than, by the way, we already took out the developing markets. I did it in the context of second and third tier markets question. In terms of fiber to the home, even the great titans have not made it work to date. The economics haven't been there historically. But now we're seeing a whole new round of fiber to the home builds, business models, and that last mile component has always been a problem in our industry, probably the critical problem in our industry. How's it going to work this time, Warren?
So we haven't made a huge splash in the U.S. market yet on fiber to the home, but we've been studying it very carefully. Valuations are probably higher in fiber to the home than I think in almost any other subsector. Rightfully, right? First mover advantage, and obviously cables have traded up to, somewhere in the low double digits. So you're seeing very, very high double digits, sometimes high 20s and that was the earlier question of greenfield fiber to the home businesses, but you can build at 3, 4, 5 times. There's a lot of overbuilders out there for sure, and I think what we've found, at least from my perspective, is the overbuilders that are focusing on areas where they can get first mover advantage will win. If they're careful and they're disciplined, and I think ultimately a lot of those businesses will consolidate over time and get bought out. But there will be, I think, I don't know if it's a day of reckoning, I don't know if it's a .com 2.0 implosion, but there's billions and billions and billions of capital being poured into fiber construction right now, and areas where there's far more than 3 competitors. And from my perspective, when you're sort of 4th, 5th, and 6th, those are areas where you're going to be building, you're not going to be penetrating, and you're not going to be able to pay your bills. So I think you will see a tremendous amount of carnage in the fiber construction business over the next, or at least on the provider part of the business. I think the actual construction guys and gals are going to do very well for the most part, because I do see a very long-term cycle of fiber construction. But the providers, I think there's going to be some serious consolidation. That was a 3-minute mark over the next 5 to 10 years.
Yeah, in fact, as we wind down here, I wanted to at least get to one more question. As I say, we all properly so high-five ourselves throughout the industry, but it's not like shooting fish in a barrel here. Josh, there's pricing pressure, fierce competition, declining ARPU. How do you contend with some of those aspects of the industry?
Yeah, I like to use the iPhone analogy when I get asked this declining ARPU question. It's kind of like the iPhone 12. When it came out, it was expensive. It was as expensive as the previous version. That iPhone 12, the same model over time, gets cheaper and cheaper. Apple will sell it for less. You get secondary market. The old technology gets cheaper and cheaper. But guess what? 2 years later, there's iPhone 13. And people will trade up for the new technology and pay about the same amount, maybe sometimes a little bit more, maybe sometimes a little bit less. But that's very similar to a lot of the sectors we see in fiber data centers and towers. The underlying customers trade up for that upgrade in technology because they need it for, their various purposes.
Corey, how are you dealing with the pricing pressure?
Are we dealing with the pricing pressure?
And declining ARPU, yeah.
Well, so we obviously deal with the leases and tenants. So we've actually seen the pricing pressure go the other way. So we had significant pressure on pricing on the downside, and now we've seen price per kW going up over the last 6 months. So I think different than the question you're asking about ARPU, but we've been waiting for that trend of the pricing to sort of move back to positive for ownership, and we've seen that happen. It's a supply and demand issue really right now.
And Warren, we're under a minute. Bring us on home here with that.
I can give another perspective. I think that, first of all, obviously, as Josh said, you replace it. Volumes continue to increase, right? So ARPUs or pricing pressure gets offset by increasing demand for more bandwidth. That's one. Two, I think from my perspective, as I look at our 26 portfolio companies, and at least I look at the ones in North America, the better service you can provide, the better solutions you can provide to your customer, the stickier that customer is going to be, and they're going to appreciate it. And I think that's where you can, it's not just about price. You can have a negotiation that it's not just a commodity. The ability to provide the best solutions in an ever-changing environment where network solutions are increasingly complicated, you're going to be able to hold price and negotiate on service and quality. 10 seconds left.
That's well done, Warren.
So with that, I will use my final 5 seconds now to thank the distinguished panel for your contribution. It's been great.
Thank you.
Thank you.
Thank you.
Good job.
Thank you.
Thank you to Kamal for the expert moderation, and to Corey, Josh, and Warren, and Stephen, our fallen comrade, for taking the time to impart some pearls of wisdom and share their expertise on the subject. I'd once again like to thank all of our sponsors for their support with this. Up next at the top of the hour, we have an interactive forum discussion looking at how we plug the talent gap. So please stick around for that and get involved. Thanks a lot.